Welcome to another episode of Founders Club. Today I'm going to be talking to Sarry Ibrahim, who is the founder of Financial Asset Protection and the host of Thinking Like a Bank podcast. Today we're going to be talking about how you can become your own bank through a concept called infinite banking, and how realtors, buyers, and real estate investors can leverage this concept to get money to fund their real estate deals, home repairs, and property flips. We're also going to be breaking down how the concept of infinite banking can help protect retirement accounts, real estate deals, and businesses from market failures and other predatory risks. If you have any questions, put them in the box down below. Make sure you judo chop that like button so other people just like you can find this video. Also, make sure if you haven't already that you join our Facebook group. It's free and there's a ton of great value in there. Links in the description. And as always, if you like money and you like real estate, hit that subscribe button because this is the show for you. We'll see you on the inside. Welcome to Founders Club, the show for real estate entrepreneurs. All right, so welcome, Sarry Ibrahim. Very excited to be talking to you today. I think you've got some very cool strategies on using insurance policies in creative ways for real estate investing,
Mhm.
for earning cash flow, for tax, protection and reduction. So really excited to kind of dive into all that with you today and learn a lot more about it. But before we dive into all that, why don't you tell me just a little bit about your background and how you found your way into that space?
Yeah, thank you for having me on the podcast. I appreciate it. It's nice to meet you and the audience. I'm from Chicago, Illinois, born and raised here. I started this journey of being a financial planner when I was about midway through my MBA program. I started working for like different insurance companies. My first job was at Allstate, and really liked it. Really liked working with a lot of investors and entrepreneurs. And that kind of led me to starting my own company called Financial Asset Protection. So it's a financial services firm, and we specialize in infinite banking for real estate investors and business owners in all 50 states. And it also led to the podcast, our podcast called Thinking Like a Bank podcast, which is, as you can imagine, what it sounds like. It's about how to think like a bank, how to apply the same strategies and principles that banks use. Because I've been noticing that as as I went through from W-2 employee to self-employed, it obviously changed a lot of the mindset, right? The mindset changed. But then being an entrepreneur and then working with other entrepreneurs, I still noticed there was another thing missing, and that is relying on banks for financing. So in essence, I feel like a lot of entrepreneurs work for banks indirectly. And then if we could kind of
Mm.
figure out a way to insource that function or insource that part, then I think then we can ultimately be free and be like true entrepreneurs if we could insource our own financing. So that's what I do. I help real estate investors and business owners become their own sources of financing.
Yeah, I love that. I love the idea of, thinking like a bank, becoming your own bank. Because the banks always seem to win.
Yeah.
And so, obviously we like that, but just, doing deals, financing deals, having access to cash is obviously critical in the real estate game. And so I just want to kind of like, let's take it from the top, maybe let's just start with what is the infinite banking concept?
Yeah, definitely. So it was invented by Nelson Nash during the 80s, and it was really introduced in his book, Becoming Your Own Banker. And what he talks about is in the book, he talks about how much interest he was paying to other lenders. And during the 80s, interest rates were like 15%. So he was paying a lot of his profits were going to service all types of debt. And then he
Mm,
discovered this way of there was already whole life insurance was already invented at that point. Whole life insurance has been around for like over 150 years, but he just figured out a way to create a higher cash value portion, because prior to that, whole life insurance policies were really just really long-term life insurance policies. So that's all they were. But he figured out a way to amplify the cash value in the policies and how you could borrow against the policies, how you could leverage them. So essentially, that's what infinite banking is. It's using cash value, whole life insurance, building up as much cash value as you can in it, and then leveraging it, like borrowing against it, using it for real estate, using it for your business, paying it back, and then ultimately using it for retirement income, using it for more businesses on a tax favored basis, and not having to worry about what the economy does, what the markets do.
yeah, yeah, I really like that as a concept, and I want to dig into that a little bit. One of the things I saw is it's an opportunity to save retirement accounts,
Mhm.
real estate properties, and businesses from market failures and other risks, which is
Mhm.
obviously, in the times we're in now, I think very important and could definitely have its major advantages. So why don't we start by talking about kind of how it works and how it allows you to become your own bank?
Yeah, well, you would a very basic way is like a very simple way is you would start funding the policy through premiums, and
And
after
this
you start
is what type of policy again?
a whole life policy, whole life insurance policy.
So it's a life insurance policy that allows you to borrow against it under certain criteria.
Yeah, yeah, and that's a good point. Now, let me just back up for a second. So you have, in general, you have two types of life insurance. You have term life insurance, which is just life insurance, exactly what it sounds like. It's either 10 years, 20 years, 30 years. It expires at the end of that period, and it has like a fixed life insurance amount. Like let's just say $1 million for 20 years or whatever the case might be. That's what most
Okay.
people usually have. That's what most people
Right.
know about life insurance. And then there's cash value life insurance, which is it could be index universal life, it could be variable universal life, it could be whole life. So we're talking about whole life insurance under the cash value section. So there's two parts to it. There's a life insurance part and there's a cash value part. The cash value
Okay.
part is like a savings account that earns compound interest and dividends every year. And
Wow.
so
Okay.
yeah, so that's kind of so you're what you're doing is, and when you start funding the fall policy with premiums going into it, a portion of your premiums go to fund the life insurance, and then another portion go towards the cash value, like your collateral in the policy.
And what is that percentage on average?
Yeah, it's a conservative rate. It's not like nothing too crazy. With the so what on one of the policies I have, I did the math from year one to through year 30, and for with the growth, the interest growth as well as the dividends, like compounded together, it comes out to like 4.2% internal rate of return. So people in real estate, they're used to like 15%, 16%, rates of return, even higher in some asset classes. So like I often get that question, like why don't I just put my money in real estate rather than earning 4.2%? And then my response is always that it's not an either or situation. Like either we do real estate or we do cash value life insurance. Rather, it's like a both and some people even refer to it as like the and asset because you can use it alongside other assets. So you would have, for example, your policy. You could fund the policy and then leverage that to invest in real estate. And then what will happen is it'll amplify your real estate return on a tax-free basis. So instead of earning like 15%, you could earn like 17 or 18%, and that additional 2 or 3 percentage points is tax-free. So
Mm.
that's just one way it helps you amplify, and then kind of one of the reasons why real estate investors use this strategy.
Yeah, yeah, I found that very interesting as well. So just to make sure I understand, so out of your life insurance premium, a percentage of it is going towards your actual insurance policy, and then a bigger percentage is going towards the cash value in the policy. And after that accrues a little bit, and you can now borrow against it, tax free and I'm guessing preferred rates.
Yeah, exactly. So technically, you could borrow day one. So like in a very simple example, I always use is like if you put $100,000 in a policy, like let's just say it's a single premium policy, which means that it's just a single premium. There's no other premium payments needed. It's just a one-time payment. So like you did 100,000 into a policy, within 30 days, you'd be able to borrow out like $80,000 within 30 days of the policy. And then when you do take that money out, the policy keeps growing at its original cash value. It doesn't subtract from it. So like, imagine if you bought a house for $500,000 in cash, and then after that you go out and you take a loan against the property. Like let's just say $100,000 loan against the property. That loan you took out doesn't reduce the market value of your property, right? Your property is still 500,000. It's still going to appreciate at your projected return at the projected rate. The outstanding loan against the property does not reduce the value of it, right? So same thing in life insurance. When you have this policy, $100,000 example, for example, you start off with a policy, you borrow 80,000. That loan does not subtract from the value of it. It's just collateral. You're using the policy as collateral. So what happens then is the policy grows, and then you have an outstanding loan, and then ultimately when you pay that loan back, you end up ahead in your policy. So the growth of your policy outweighs what you paid to borrow that money. So like there's an arbitrage. Like you made money on the money that you used for other businesses or other real estate activities.
Mm, interesting. So how would that work in a real estate example? Like
Yeah,
how would
yeah, absolutely. So yeah, just an example, I just mentioned 100,000. Let's just say you had $100,000 in cash. You could use the 80,000 as a down payment. So that's something that a lot of real estate professionals and investors were kind of surprised by, is that they, because like when you use your money as a down payment, right? The bank is going to ask you, where did you get this money from? And if you borrow that money from someone, they're probably not going to allow it, because the bank wants to be the only lender in that situation. They don't want to share the lien or the collateral with other lenders. So, but
Mhm.
with life insurance, it's an exception to that, because and banks know, like, they know life insurance very well. It's an exception to it because when you borrow that 80,000 from the life insurance company, they know that it's a non-recourse loan, and they know that the only collateral you needed for that 80,000 was just your original policy. That's all the collateral
Mm,
you needed. Meaning that if you don't pay the life insurance company back, they can go after any other assets beyond the life insurance policy. That's it. It's capped at the life insurance policy, which is great, because when you go to take out loans the traditional way, underwriters don't see that you have outstanding loans with life insurance companies. It's irrelevant. And even if they did know, it doesn't stop you from getting more bank financing. So this is really
wow.
good if you're a real estate investor, you have multiple properties, multiple loans. And I've seen this working with clients where they'll be in the middle of a loan, and the bank says, all right, you know what, you have to pay this other lender, $20,000 or whatever, $30,000, and before we give you this loan, because of their debt to income ratios, because of other factors that they're calculating.
Right.
So you could use the policy to cover those other outstanding debts, or even the debts you have from the policy don't even count into that calculation. So it can help, even not only amplify your investment returns, it could also help you amplify the amount of money you can get from other banks, because it's non-recourse financing that you're taking out against these policies.
So that doesn't affect your debt to income ratio, things like that?
Yeah, exactly, it does not.
Wow. So you could essentially get 100% financing on a property by leveraging that policy.
Yeah, yeah, exactly. If like, the 80, for example, you put 100,000 in, the 80,000 is borrowed from the company, then yeah, you could use that as your 20% or your 25%. And then yeah, you're right. It's
Wow.
like 100, it's almost like 100% financing.
That's very cool. Okay, so then talk to me about like how that loan process would work, right? Like if in your example, I have a policy, it's worth 100,000 cash value. I can borrow 80,000 out of it. How does it work? What do I do?
Yeah, it's a very simple process. You just fill out a form. One of the companies you work with even has like an online portal that you can go to access to. You could borrow the loan like in an online portal, like an online banking kind of. So you could do it that way, or you could send the form to the insurance company. It takes about 3 to 5 business days to process, and the only thing the insurance company looks at is how much cash value you have, and then they give you a loan based off of that. There's nothing else required, just a 1 page form, and then it takes about 3 to 5 business days. You can have it directly deposited into your account. And then after that, it's a line of credit, so it's not a term loan. It's not a finite term loan. So what that means is that it's like an open-ended loan. It's a line of credit that you take out against it. And then the way it's calculated is, it used to be 5% for like 16 years in a row. It was 5% simple interest, and it just recently went up. I mean, no surprise, right? With interest rates going up, it just recently went up to 5.7%. So what you do is you'll take like 80,000, multiply that by 5.7%, and then divide that by 365 days. And then every day your loan balance that you have to pay the insurance company back, or technically you don't have to pay the insurance company back, but the loan amount that you owe against the policy grows by whatever that amount is. It's like $6 a day, for example. It grows every day. And then it only compounds in arrears annually. So that means after the policy anniversary year, if you didn't pay anything back at all, then the interest would compound. But in the meantime, it's simple interest. And then while that's all happening, your policy keeps growing, it keeps earning dividends, it keeps getting interest. And then you could pay the loan back if you wanted to, like monthly. You could pay it back annually. You could pay it back in the next 2 years, the next 3 years, whenever you want. And then assuming like you just never pay the loan back at all, you take out, you put 100,000 in, you take out an $80,000 loan, you never pay it back. Let's just say you die at the age of like 110 years old, and then your life insurance is 1.5 million, for example. And then let's just say your loan grew to like I don't know, like $300,000. They would take $1 million, your $1.5 million death benefit. they would subtract your outstanding loan and interest, and then they pay that to your beneficiaries. So you could see this being like a
Wow.
really advantageous way to keep borrowing, and because you're essentially you're leveraging your death benefit ultimately.
Yeah. Yeah, that's very interesting. So if so even on like a flip, anything like that, you could take that money and it's basically like you said, it's like a line of credit. So they're not sending you a check for 80 grand. You get like maybe a credit card or something that you can swipe or checks that you can write. Um, how does that work?
Yeah, so with the life insurance companies, you have to send a form in, and then you request a form, and they could either mail you a check or they could do direct deposit. But with the check, you could do a check if this is where it gets a little bit tricky. So you could do a check if you go through a third party bank, and then you go to, like, for example, you can borrow from the life insurance company itself as collateral, or you can go to a third party bank, a bank that specializes in life insurance collateral loans or loans that are backed by life insurance policies. And then
Hmm.
they'll give you like a checkbook access, and then anytime you write a check, it's like a loan. And I do see the benefit of doing that. It's just the problem is when you do it that way, there's a hard credit check involved, and you're going through a bank, and then you have to pay the interest monthly. So it takes away
Got it.
from that like freedom of the financing. It's still better than other sources of other ways of financing, but the ultimate way of financing is just directly to the life insurance company. And a credit card, I haven't seen that yet. I think that's gonna be the next step, where you go through a third party bank, and then a bank will give you a credit card, and then the credit card can
So
be
if I
used.
do it just the traditional way, then I'm getting a check for 80 grand from the life insurance company direct, and I'm paying 5.7% simple interest.
Exactly, yes.
Very cool. Wow. And then what are like the payback terms? Is there a timeline? Is there a how does that work?
Yeah, so the insurance company will not send you a bill saying like you have to pay this amount at this time. There is no, technically there is no payback period. You're your own banker. You're in charge of that. I will say that there's a chance. I haven't seen it, but there's a chance where the loan could exceed the policy, and the policy can collapse. But again, in order for that to happen, somehow, some way, the insurance policy would have to stop earning interest and dividends, and then for the loan to exceed what the policy is growing, because you have to remember, as the loan is growing, so is your policy. So you have one side, which is the loan that's growing, and then you also have the cash value that's growing. So in theory, the policy could never collapse because one side is always growing than more than the other side, more than the loan side. It's possible that it can collapse, but the way that would happen is if the policy somehow, some way, stopped growing and the loan grew and then it collapsed. But I've never seen that before.
Okay. Yeah, good bit of advice. So you can kind of pay it back at your leisure.
Mhm.
Obviously the interest is running, but I feel like this could be a great thing for like, house flippers, things like that, where they just pull the 80 grand out, do their deal, make their profits, and they can put it right back in again and then rinse and repeat.
Exactly. Yeah, that's true. Yeah, they could do it that way. And the benefit of doing it that way is they would make money, they would keep earning interest on their cash, and they would be investing in other properties at the same time.
Yeah. Wow. I like that. And let's say the money is just sitting there, you're not pulling it out. Is it earning interest at that point, or tell me about that?
Yeah, so if you're not borrowing against the policy, it's still earning interest. So the policy grows whether you take out a loan against it or not. It grows either way. And some people do that too. Like, I have some clients who just put money into a policy, and they're like, for example, W-2 employees, and they're going to put away money into a policy, and they're not really looking to, like, right now at least, they're not looking to like flip real estate or anything like that. They just want to treat it almost like a 401k, or like a retirement account that they own. It's not a
Right.
401k, just to be clear, but they want
Yeah.
the same concept as putting money away for retirement. So they treat it that way. They're just putting away like $1,000 a month for the next 30 years, and then they're going to retire off of that money.
Yeah. And what is that interest that they earn on that?
Same thing. So it's gonna be really, it's not gonna be that much. It's gonna be 3% low end to 5%. It really has to do with the dividends that the insurance company is paying out,
Okay.
because the dividends are not guaranteed, but there's a very high degree of certainty that you're going to keep getting dividends, because the insurance companies we work with have been paying dividends for over 100 years. So You'll get dividends, and the dividends that you'll get are based off of the performance of the insurance company. And then what the insurance company is doing is, number one, they're a life insurance company, so that there's profit there just by underwriting life insurance policies. And then they are also loaning that money out to their policy owners. So they're charging interest on that. And then they're loaning that money out to even real estate investors and syndications as like a bank, where they're the mortgage, they're the lender. And then
Mm,
and mostly in bonds too. So mostly interest earning activities. And then from there's profits. And then the profits get distributed back to the policy owners in the form of dividends.
wow. So they're earning 3 to 5% on their money just by having it sit there.
Exactly. Yes.
And it comes with all of the, life insurance attached to it.
Yeah, the growth is tax free. The withdrawals are usually tax free. The loans are tax free. In most situations, it's entirely tax free, income tax free. The only time it's not tax free is if it's a modified endowment contract, a MEC policy, and that is when there were certain things that, like certain rules that weren't followed, that created the policy to become a taxable event, and then you're only taxed on the gains of the policy when you take out loans and withdrawals.
Tax on the gains. Okay.
Yeah.
Wow. Um, while we're on the, the tax topic, what are the other tax advantages with a policy like this?
Yeah, so if the growth of it is growing tax free, so you're not getting like a 1099 at the end of the every year from the growth of the policy.
So the
Loans and
dividends are tax free.
yes, exactly. The loans and withdrawals are tax free. The death benefit is income tax free to your beneficiaries. Let's see what else. There's no
That's
reporting.
great.
There's no like form, for life insurance that you have to report every year, or report to. So there's nothing you have to do really with the life insurance policy. There's no like maintenance. In other words, you don't have to hire
Mm,
like. I mean, you should talk to your CPA. You should talk to your attorney about doing this, but it's not required. Like other tax strategies I've seen, like you have to like hire like an engineering company. You have to document. You have to file these forms. There's maintenance involved and administrative expenses involved in getting those tax benefits, but not with this strategy. It's just a very simple process. Again,
mm,
talk to your tax professional about doing the strategy, but there's really no reporting required.
that's awesome. Um, and then I also see that it offers privacy and asset protection. So let's talk about that piece of it. How does that play into it?
Yeah, that's one of my favorite parts of the strategy is that in most states, the cash value of the life insurance policy doesn't is not it's an exempt asset. So what that means is that usually you have some assets in lawsuits, and don't I'm not an attorney, so don't take my advice. Talk to your attorney about this. But there are, in general, there are assets that are exempt assets and then non-exempt assets. So in general, an example of a non-exempt asset could be like a checking account or savings account. It's very visible if you're in a lawsuit, if you're in bankruptcy. It's like the low hanging fruit. Whereas an exempt asset is like a pension or annuity or a life insurance policy, something that you need for your family, for yourself,
Mm,
regardless of the bankruptcy situation or like a creditor situation. It's like a preferable asset that you need. So in a lot of states, life insurance is seen as that way, an exempt asset. You can even look up like the I have a PDF on my website. You can go to and download. It's like it has the statutes of every state and what it views life insurance as. And most states view it as an exempt asset. So it protects the life insurance and the cash value. And then some states have some exclusions, like up to X amount of dollars is an exempt asset. And then some states it's not really that exempt. Like my state, Illinois, it's really good with life insurance. Florida is probably the best state for any asset protection in general. It's the homestead exemption and all the other rules. Florida is the best state for that. And then it's usually aligned with pensions and annuities because people need those for survival. They need those for their families. So that's a really good strategy to look into if you want to look into life insurance as an asset protection
wow.
tool. Talk to your
Yeah.
estate planning attorney or your asset protection attorney. But life insurance is usually one of the best vehicles for that.
That's interesting because now you can park money there. It can't be touched,
Mhm.
from predatory attorneys or any
Mhm.
situations that you might get yourself in. And you can borrow against it, which is very interesting.
Exactly. Yeah, yeah. You can get the tax benefits. You can get the asset protection benefits. It's not affected by market conditions. And I could talk a little bit about that. Like, if, for example, if the stock market goes down 50%, or if there's another 2008 happens, the cash value in the policy is not correlated to the markets. It's not affected by that because of what the insurance companies invested into. It's mostly interest earning activities. It's mostly bonds. At that plus the law of large numbers. These are insurance companies that have been in business for over 100 years with billions of dollars, some of them even hundreds of billions of dollars in reserves. So even if their bond performance went down, it doesn't correlate with your cash value. Your cash value doesn't go negative ever. It never decreases
Mm.
in value because of market conditions. So you get the market protection, you get the tax benefits, and then you get the asset protection benefits. And then you also, another one you can even add is the interest protection, because when interest rates go up, it's typically not good for the economy because people have a harder time getting financing, and then that constricts the economy. However, with life insurance policies, when the interest rates go up, the dividend rates go up as well. So in these
Mm.
policies, the interest rates are correlated with their dividend rates. So dividends go up, interest rates go up, and then
Wow.
when interest rates go down, dividends also go down. But then also the cost of capital goes down. So it's either in either scenario you're like winning in terms of interest rates and life insurance policies.
Yeah, no, that's very cool. And so how does the actual life insurance piece fit into all of it?
Yeah, so you have the death benefit. The death benefit is also growing every year. The life insurance part, you can name, your beneficiary. You can use it for your company. Your company could be the beneficiary. You could use it for partnerships, for LLCs, for syndications. It could be used for, you could put, anyone who has an insurable interest, you could put as a beneficiary. Like your spouse, children, business partners, your company, and it grows every year. And then if you have any outstanding loans against the policy and you pass away, the insurance company will pay out the death benefit minus the outstanding loans and interest. It's income tax free. And then I'm thinking, anything else you want to know about the death benefit?
No, I think that pretty much covers it. So it sounds like it very much runs like a standard insurance policy.
Mhm.
You can name whatever beneficiaries you want, which is great, including companies. So I see that being a big advantage. Um, what about how does the death benefit and the cash value work together? I'm assuming if one goes up, one goes down, and vice versa.
So you have the cash value, then you have the death benefit, right? So they're both going to be growing every year. They won't go down unless you withdraw the policy, unless you surrender the policy or do a cash surrender. So when you do a cash surrender, it directly withdraws from the cash, and then that will directly reduce the cash value and directly reduce the life insurance. So they are kind of like, so the cash value is one section, and then the life insurance is on top of it, and they're both going up. They only go down when you do a withdrawal, when you subtract from the policy. And the only time you'd want to do that, subtract from the policy, like withdrawal, is in retirement. That's the only time I'd recommend it. I wouldn't recommend doing withdrawal ever until you're in retirement, because you always want to borrow against the policy, because it's going to keep growing. You get all these benefits when you're leveraging the policy. So I always recommend clients do not withdraw against the policy. Always keep borrowing against it. It's not like you're using a credit card, with interest at your high interest. You're borrowing against a policy in which you're a mutual owner of the insurance company. So keep
Right.
using that as a way to borrow against it, but do not withdraw, and then only withdraw in retirement. So in retirement, you start to see your cash value and your life insurance going down, assuming you have it set up for like recurring income, like a pension, almost like recurring income, where you're getting X amount of dollars every month out of the policy, and that's going to reduce your cash value and your life insurance.
Wow, yeah, okay. So that makes sense. What about when you do withdraw? Is there penalties or is there like you said, wait till retirement, but if they do that, are they taxed on it? Is there penalties?
Yeah, life insurance, there's no penalties on withdrawals. And then when you do withdrawal, it's tax free up to your basis. And then after your basis, what we would usually do is borrow after that point. So let's just say you put $100,000 in basis over the years in your policy, and then now it's retirement, and then you're taking out like $2,000 a month. You would take out $2,000 a month tax free up until your basis, which is $100,000. And then after your basis, you would borrow after the basis.
That's very interesting. So that's a good retirement strategy as well.
Mhm. Yeah, absolutely. Yeah, definitely. We try to do it like where it's all tax free. So We work on the life insurance policy, so it's tax-free income. We also do Roth IRAs, so that way that you can also get tax-free income from Roth IRAs. And then if you have Social Security income and you get like the standard deduction, there's three sources right there of tax-free income in retirement. So that's something we try to help our clients do, is almost have entirely tax-free income in retirement.
Yeah. No, that's awesome. Okay, so let's talk about like who who is this good for and who is this not good for? Like who would not want to do this?
Yeah, who would not want to do this is someone who is very concerned about, like, you know income this month, not income, but investment return, like this month or next month, like very short term. Like a day trader, I feel like wouldn't. I mean, not to discriminate, but I feel like day traders wouldn't really like this because they're constantly thinking about like how to make more and more money on a daily basis. I think somebody who is more long term, like long term vision, like at least a 20-year vision, I think would help out a lot. And somebody who's not so concerned about the, because one thing too is you have to remember is, like in the example I mentioned, you put 100,000 in and then you could borrow 80,000. Some clients might be like, what happened to that $20,000 difference? And that $20,000 difference is, some of that goes to fees to the insurance company in the first year. It's already embedded inside the premium and the cash value of the
Mhm.
policy. It's not like you have to pay extra to do this. It's already embedded in the premiums and cash value. But some clients might be like, what happened to the difference between that? Where did that go? And that goes to administrative expenses, and then you get that back through interest and dividends. So it's an investment. You're paying for the policy, there's a cost of insurance, and then you get that back in the later years. So if you're really concerned about that, like paying for the administrative expenses of a life insurance policy, then that's probably not going to be a good fit. So really long-term vision, and you're comfortable with the investment aspect of it, where you're paying something for something and then getting it back in the later years through your investment, through your dividends and interest that you'll earn.
Yeah, the idea is that you'd want to hold this for a long period of time because then you're getting that 3 to 5% dividend. Hopefully you're borrowing
Mhm.
and making money and then putting the money back and then repeating that cycle to kind of maximize everything.
Exactly. Yeah.
Wow, very cool. Um, any other downsides we should be aware of?
Yeah, you mentioned a good point. You want this long term, because let's just say, for example, you put 100,000 in and you do a surrender of 80,000, then that loss of 20,000, it's lost. So you want to keep the policy so that way you can actually get the gains out of it. Other than
Mm,
that, make sure that you're talking to a professional, not just somebody with a life insurance license. There's about 2 million people in the US that have a life insurance license. So not everyone with a life insurance license could do this strategy. You want to make sure that they're either part of the infinite banking group, the IBC group, or I'm a bank on yourself professional. So you want to make sure it's somebody who's part of some sort of group of an accreditation group, who specialize in life insurance policies for cash value purposes. Again, it's not just a general insurance thing that like your local auto insurance agent who has life insurance license can do. It's something it's specialized, and you need to make sure it's right, because if it's not right, it could be taxable. The policy could grow very slowly. You can pay a lot of money in fees and commissions. So you want to make sure it's strategically built. It's built properly for you, and even more importantly, it's relevant to your financial situation. So it's not like this is a strategy where everybody gets the same policy, everybody does the same thing, everybody does the same policy. It's very niche, it's very specific, it's tailored. Like, you have to go through, what I always do with the clients is I go through a financial analysis meeting with them, and I get an idea of their income, their net worth, their goals, what they're doing. Are they a real estate investor? Are they a business owner? What's happening in their business? Are they married? Do they have kids, grandkids? And put all that together into an analysis, and then make a recommendation after that. Because I can't just make a recommendation without knowing somebody's financial situation. It could actually harm them in that situation. So make sure the person you're dealing with is thinking that same way, where they're providing you a relevant solution, not just a cookie cutter situation where it's
yeah,
everybody
it's
has the same
very much a
policy.
full picture decision. They got to
Yeah,
look at the full picture. Yeah.
exactly. Yes, precisely.
That makes sense. So people that want to learn more about this, thinkinglikeabank.com. That's your website, right? That's where they can
Yes.
get a hold of you. I'm sure you've got lots of resources there that go into this in more detail. So thinkinglikeabank.com if you want more information. Any anything you want to add to that?
No, Oliver, thank you very much for having me on your podcast. It was nice talking to you and nice getting to know you.
Yeah, likewise. So I got one final question I
Yeah.
like to wrap with, and that is, In 60 seconds or less, what does it take to be successful with setting up your infinite banking system
Yeah,
and thinking like a bank?
Mhm. Identify your goals, what you want. I would say like a 5-year goal, 10-year goal, 20-year goal. Identify your current situation, your current net worth situation, your income situation, and then like your projected situation, like how much you think you'll keep earning in the future, and then how you want to use the policy. So kind of like get an idea. Do you want to use it for financing your properties, for retirement income, for asset protection needs reasons? So you're the goals of using your policy, and then yeah, make sure you're working with somebody who can help you with this. It's definitely a who not how situation, as Dan Sullivan calls it. Who not how. Like make sure the who that you're working with knows what you want to do. And then also do your research. There's a lot of podcasts about on infinite banking. Like if you just Google infinite banking podcast about infinite banking, you can check out podcasts like this. You can check out our podcast, websites. Do a lot of research. It's going to take time to understand it, and you want to understand it before getting into it. The last thing you want to do is just sign wherever your agent tells you to, and then just pay premiums, and then all of a sudden 2 years later you're like, how come my money isn't doubled, or something like that. Like there's a big misunderstanding about it. So make sure you understand how everything works now and in the future too.
Okay, I like that. I'm going to ask actually one more bonus question. Another in 60 seconds or less. What are the best things that you've seen people use that money for investment wise to make this thing work the best or get the highest returns?
Yeah, I've seen it work many ways. The best way is like a contingency fund for a business. Like if you're a business and you have like, cash coming in and out of your business, and you have some time, like you have like some expenses, you can wait like 3 or 4 months to pay them, depending on what you do, the type of work you do. This is a really good place to park the money in the meantime and grow like with compound interest in the meantime. So this way
Mm.
you're like a bank in essence. Like you're holding deposits and earning interest in the meantime on that money, and then paying your expenses or whatever. So that's one of the I've seen it used many ways, but that's one way I've liked to see a lot.
Mm. Yeah, that makes a lot of sense because now you get a life insurance policy as a business owner
Yeah,
and you can draw on that cash in case of an emergency. It's just sitting there, it's earning 3 to 5% and you can pull from it whenever.
exactly. Mhm.
Very cool. Well, hey man, I really appreciate your time and thanks for coming on and educating us on this. It's a
Thank you.
very cool concept. I'm definitely gonna dive more into it and learn a little bit more. And thank you again for coming on. As always, guys, if you like real estate and you like money, this is the show for you. Hit that subscribe button, and we'll see you on the inside.
Thank you.